Ladies and gentlemen, I need you to stop scrolling for the next few minutes. What I'm about to share with you could be one of the most important alerts you've heard in months, maybe even years if you own silver. I'm not here to speculate, I'm here to warn, because right now the global silver market is teetering on a razor's edge, and if you hold silver today, you have just a few days left before whatever comes next begins to unfold. Right now, the silver market is approaching a moment that doesn't happen often. And when it does, it rarely gives a second chance. Most investors are focused on price headlines or short-term noise, but the real story is developing beneath the surface where supply mechanics, institutional positioning, and policy decisions intersect. This is where major moves are born. What we are seeing is not random volatility. It is a pressure buildup. When pressure builds long enough, the release is sudden, decisive, and unforgiving to anyone who is unprepared. Silver has spent months compressing into a tight range after a powerful advance. Historically, this type of price behavior is not a sign of weakness. It is a sign of absorption. Large players don't chase price that accumulate during periods of confusion and hesitation. While retail investors debate whether silver is too high or about to crash, professional money is focused on flow, availability, and timing is becoming critical. Several market triggers are aligning almost simultaneously, creating a narrow window where positioning matters far more than opinion. One of the most important factors right now is the shifting structure of global silver supply. Physical availability is quietly tightened while demand remains elevated, particularly from industrial sectors that cannot simply substitute another metal. This creates a fragile equilibrium. When supply chains are stretched and inventories are thin, even a modest disruption can cause exaggerated price reactions. Markets don't move smoothly in these conditions, they gap, spike, and flush. That's why the next few days are so important. Once the imbalance becomes obvious, the market will reprice rapidly, and that repricing will not wait for confirmation from the mainstream narrative. At the same time, we are seeing warning signs in the derivatives market. When margin requirements increase or liquidity tightens, leverage participants are forced to react. This doesn't happen gradually, it happens all at once. Weak hands are pushed out, stops are triggered, and price moves violently in whichever direction has the least resistance. This is why silver is so dangerous and so powerful at the same time. It is a relatively small market with outsized reactions. When a trigger hits, silver doesn't politely trend, it explodes or collapses before most people understand what happened. Another critical element is sentiment. Sentiment around silver is currently split, which is exactly what you expect near a major turning point. Bulls see long-term deficits and structural demand. Bears see recent volatility and fear a sharp correction. When both sides have strong arguments, it usually means the market is close to resolution. Indecision creates energy, and energy eventually converts into movement. The market does not reward consensus, it punishes complacency. If everyone felt confident about what comes next, the opportunity would already be gone. This is where strategy becomes more important than conviction. Owning silver is not just about believing in higher prices, it's about understanding where you are in the cycle and how much risk you are exposed to when the market makes its next decisive move. Latest stage cycles are notorious for emotional decision-making. People either hold too long because they are convinced price can only go higher, or they panic out at exactly the wrong moment because volatility overwhelms their plan. Both outcomes are avoidable, but only if you recognize that you are near a pivot, not the beginning of a calm trend. The phrase "a few days left" isn't meant to create drama, it reflects how markets actually work at inflection points. Once a catalyst is absorbed by price, the opportunity disappears. The market doesn't send reminders, it moves and then it moves on. Whether that move is up or down is less important than being prepared for the magnitude of the move. This is where position sizing, risk management, and awareness become essential. Silver can make years of gains in weeks, but it can also erase months of progress in days. What makes this moment especially important is that silver is not operating in isolation. Broader financial markets are stretched, liquidity conditions are changing, and confidence in traditional systems is being tested. In environments like this, metals often act as both refuge and release valve. That dual role creates instability in price behavior. It's not clean and it's not comfortable, but it is predictable if you've seen it before. The key takeaway is simple: this is not the time to be passive or unaware. If you own silver, you are already involved in what comes next. The only question is whether you understand the risks and opportunities in an interview. The market is setting up for a decisive move driven by structural factors, not headlines. When that move begins, it will be obvious in hindsight and shocking in real time. Preparation happens before the move, not after. Silver is entering a phase where volatility is no longer a warning sign. It is the signal itself. When markets begin to swing sharply after an extended run, most people assume something is wrong. In reality, this is how major transitions begin. Volatility doesn't appear randomly. It shows up when control shifts, when leverage becomes unstable, and when the balance between buyers and sellers can no longer be maintained quietly. Right now, silver is flashing those signals with unusual clarity. Over the past cycle, silver pushed into price territory that hadn't been sustained in decades. That move didn't happen because of hype alone. It was driven by real demand, tight inventories, and years of underinvestment and supply. But when price rises that far, that fast, it changes market behavior. Leverage increases, speculation grows, risk management loosens. At that point, even a small change in rules, liquidity or sentiment can trigger out, says reactions. This is exactly where silver finds itself. Now, we've already seen how quickly things can shift. Sudden drops following margin changes and liquidity adjustments caught many participants off guard. These weren't gradual pullbacks. They were sharp emotional moves that forced traders out of positions whether they wanted to exit or not. That's important because it reveals how fragile positioning has become. When a market reacts violently to mechanical changes, it tells you that too many participants are leaning in the same direction with borrowed confidence. Silver is particularly sensitive to this because it sits at the intersection of two worlds. On one side, it is a monetary metal influenced by inflation expectations, currency stability, and confidence in the financial system. On the other side, it is an industrial metal driven by real-world consumption and technology, energy and manufacturing. When both sides pull at the market simultaneously, price behavior becomes erratic. The market is forced to constantly repress what silver is worth, and that creates instability. This instability is not something to ignore, it is something to respect. When volatility expands after a long buildup, it often precedes a decisive trend change or acceleration. Markets don't move from calm directly into sustainable trends. They pass through chaos first. That chaos is what shakes out weak positions and resets expectations. Anyone who has watched silver over multiple cycles knows this pattern well. The biggest moves rarely come when everyone is comfortable. They come when conviction is tested. Another layer to this volatility is sentiment. Silver sentiment has swung wildly in a short period of time. One week it's optimism and breakout talk. The next it's fear and crash predictions. This emotional whiplash is not accident. It's the result of a market searching for equilibrium and failing to find it. When price can't stabilize despite strong narratives on both sides, it means something larger is being worked through behind the scenes. This is why the coming days matter so much. Volatility compresses time. Decisions that normally play out over months get forced into days or even hours. If you are not prepared, the market will make decisions for you. Stops get hit, margin calls arrive, emotional reactions replace strategy. That's not a theory. That's how these markets actually behave when volatility takes control. For those holding silver, this environment demands awareness, not prediction. You don't need to know the exact direction of the next move to understand its potential impact. Sharp moves cut both ways. A violent sell-off can present opportunity, but only if you have capital and discipline. A breakout can deliver massive gains, but only if you're positioned in a way that allows you to stay in the trade through turbulence. Volatility punishes overconfidence more than it rewards optimism. It's also important to recognize that volatility tends to expand when markets approach important inflection points. This isn't the middle of a quiet accumulation phase anymore. This is late cycle behavior where risk increases even as opportunity grows. That combination is dangerous for those who confuse conviction with control. The market doesn't care how strongly you believe in silver. It responds to positioning, liquidity, and pressure. What makes this moment especially critical is that silver's volatility is occurring alongside broader financial uncertainty. When liquidity tightens elsewhere, it spills into smaller markets first. Silver, being relatively thin compared to equities or bonds, feels that pressure immediately. This is why moves can appear sudden and irrational. They aren't irrational, they are fast. The key message here is not fear, but realism. Extreme volatility is a signal that the market is approaching resolution. Something is coming, and it will not be subtle. Whether silver surges or shakes out first, the move will likely surprise those who are complacent. Preparation means understanding that this is no longer a low-risk environment. It means adjusting expectations and respecting the power of a market that is under stress. Volatility is the market speaking loudly. Ignoring it is not an option. Silver is standing at a crossroads, and the forces shaping its future are bigger than headlines, bigger than speculation, and bigger than short-term sentiment swings. The most important driver in any market, especially one as tightly held as silver, is the balance between supply and demand. Right now, that balance is under pressure in ways that most casual investors simply don't see. While prices fluctuate on charts and social media debates rage about highs and lows, the real story is the scarcity of physical silver and the increasing difficulty of obtaining it in meaningful quantities. Industrial demand continues to grow while supply is constrained by production limits, mine closures, and logistical bottlenecks. Every ounce that isn't readily available tightens the market and raises the stakes for anyone holding position. This is not an abstract concept. Global inventories are shrinking, and the number of coins, bars, and ETFs accessible for immediate delivery is declining. Meanwhile, demand is not slowing. Solar panels, electric vehicles, and advanced electronics are consuming silver at rates that are structural, not cyclical. When production cannot keep up with this structural demand, price becomes more sensitive to shifts in buying pressure. Small changes in sentiment or liquidity can result in large price swings. It's like a compressed spring. When the tension is released, it releases quickly, decisively, and often in a way that surprises those who think the market moves gradually. The physical shortage also magnifies the impact of trading on futures and derivatives markets. When inventories are thin, those trading paper contracts must constantly adjust their positions to reflect real-world constraints. This creates additional pressure on races and can accelerate trends. The market is incredibly interconnected. A decision made by a major holder of physical silver in Asia or Europe can ripple through the global futures market within minutes. That's why professional participants watch both physical availability and paper flows closely. When those two forces are misaligned, volatility becomes inevitable. Another factor influencing the market is timing. Markets don't respond to scarcity or demand in a linear way. They respond when participants perceive that the window of opportunity is narrowing. When it becomes clear that access to physical silver is tightening, investors begin to act simultaneously, and liquidity can vanish almost overnight. That simultaneous reaction magnifies moves in price and creates opportunities for those who are prepared, but it also punishes those who are not. The next few days are crucial because the market is entering a phase where timing is everything. The difference between acting early and reacting late could be the difference between gains and losses. The current environment also amplifies risk and reward. Markets in scarcity conditions can behave unpredictably because human behavior compounds structural pressures. When investors fear missing out on a limited resource, they tend to overcommit, creating momentum that pushes prices beyond what fundamentals might suggest. Conversely, fear of sudden liquidation can trigger rapid sell-offs that temporarily overshoot value to the downside. Both extremes are possible, and both are amplified by the thinness of the market. This is why understanding the mechanics of supply and demand is more important than guessing whether prices will rise or fall on any given day. It's also essential to recognize that silver supply-demand imbalance is not a temporary anomaly. Structural demand continues to increase while new production faces rising costs. Regulatory hurdles and geopolitical risks, these are long-term pressures that create a backdrop for short-term volatility. The market doesn't need an immediate shock to move dramatically. It just needs participants to recognize that scarcity exists and act accordingly when enough participants acknowledge the imbalance. At the same time, price movements are accelerated. That's why those watching closely can anticipate significant action before it appears in mainstream reporting. Even though headlines focus on price swings, the reality is that the fundamental picture is clear. Physical silver is scarce, demand is structural, and supply is constrained. These conditions alone create an environment ripe for significant moves. Understanding this dynamic allows investors to approach the market strategically rather than emotionally. Preparation, awareness, and timing are critical. Complacency in a market this sensitive can be costly, while those who respect the underlying pressures can navigate volatility effectively and capitalize on the opportunities that arise in the coming days. The market will likely test the limits of this imbalance, whether through price spikes, sudden liquidity shifts, or rapid adjustments in futures positions. The forces of scarcity and demand will assert themselves decisively. Silver has always been a market that rewards patience and understanding, but punishes complacency and ignorance. Recognizing the structural pressures and the narrowing window to respond is the key to navigating what comes next. This isn't speculation, it's an observation of the mechanics at work, a close reading of the market's DNA. For those who pay attention, the signals are clear, scarcity is rising, demand is relentless, and the market is about to make its next significant move. Silver is approaching a moment where the market's behavior will no longer be incremental or predictable. What we are witnessing is a setup that has been forming over months, driven by a combination of structural imbalances, leverage positions, and mounting market stress. Most investors look at silver price charts and see noise, but what really matters is what is building beneath the surface, the pressure that comes from an intersection of supply constraints, industrial demand, and financial positioning. This is the point where opportunity and risk collide, and timing becomes everything. The dual nature of silver, both an industrial and a monetary metal, is what makes its movement so extreme. Industrial demand is relentless, fueled by technology, renewable energy, and advanced manufacturing. Meanwhile, investors view it as a store of value, a hedge against inflation, and a way to diversify exposure to traditional financial markets. When these two forces are pulling in different directions, the market becomes highly sensitive. Small shifts in sentiment or liquidity can produce outsized reactions because the market is thin relative to the size of demand. That sensitivity is magnified when positioning is concentrated or leveraged as it currently is. Leverage is a key factor in how silver behaves in these moments when participants use borrowed funds to amplify exposure. Even minor changes in margin requirements or liquidity conditions can cascade through the market quickly. We have already seen examples of this in recent months where sudden adjustments created sharp moves that caught many investors off guard. These are not isolated incidents, they are warnings. They reveal how quickly the market can move when pressure reaches a tipping point, and why understanding the underlying mechanics is far more important than simply guessing price direction. Timing in this environment is critical. The market is entering a phase where action compresses into a very short window. What normally would take weeks or months to develop is now occurring in days. Awareness and preparation are the differentiating factors between success and failure. Investors who recognize that a significant shift is imminent and who adjust their positions accordingly can navigate the turbulence. Those who wait for confirmation or rely on conventional signals are likely to find themselves caught on the wrong side of a move. Sentiment is another driver of instability. Right now, silver sentiment is polarized. One side focuses on the long-term fundamentals, supply deficits, industrial demand, and structural scarcity. The other side worries about volatility, short-term corrections, and potential liquidity squeeze. When both sides have strong convictions, the market becomes a pressure cooker. The energy generated by indecision and conflicted positions often leads to sudden, decisive move. Markets rarely transition from equilibrium to trend without first passing through a phase of turbulence. And that is exactly what is unfolding in Seoul. It's important to emphasize that this volatility is not a threat in itself. It is a signal. It reflects the market testing limits, adjusting to imbalances and preparing for a resolution. Observing these dynamics allows participants to act strategically rather than react emotionally. The goal is not to predict every short-term fluctuation, but to understand that the market is at an inflection point where measured action will determine outcomes. Structural pressures are also intensifying. Supply constraints are becoming more pronounced as production growth slows, and existing inventories are drawn down. At the same time, industrial consumption continues to rise, leaving less metal available for investment purposes.